Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me again on the program is Mark O'Byrne from GoldCore. How are you today, Mark?
Very good, Tom. How are you?
I'm great. Hopefully we have our audio issues fixed. We apologize to everybody from our last interview and hope that this one turns out much better.
Yeah, very good.
Mark, we were speaking before the call about how we've seen China and Russia really hoarding gold in the last couple of years. And it really makes me wonder what you think the advantage to that is going to be going forward when we see the environment developing that we do with central banks printing their currencies into oblivion. How are those central banks and or countries going to be able to leverage that much gold that they have?
Yeah, well, basically, they realized that having a strong currency, a currency that is attractive both to their citizens and to the wider world, is important. And they look at the US with great envy in terms of the exorbitant privilege that the US has had for the last nigh on 100 years, and prior to that, the British Empire. So they realized that the reserve currency, particularly the Chinese, but also the Russians, realized that the reserve currency status that the US has enjoyed and allowed the US to consume much of the planet's resources and live way beyond their means for a long period of time. They realized that the advantages of this, particularly in a world where we're going into a severe depression and currencies are going to be devalued in a big way, and inflation is we're going to have virulent inflation at some stage as well. So by having gold component in the reserves and potentially backing their currencies in some ways with gold, whether it be partially backed or it's unlikely to be fully backed, but partially backed, means that it's a way to preserve the standard of living of the citizens as well, because it means that their currency is less likely to be devalued. So, the short answer is, I suppose, there's a number of advantages, and they do realize that the most powerful nations in the world and the strongest economic nations in the world tend to have strong currencies. And you look at obviously the UK and Britain during the British Empire, the US in the last 100 years. And even if you look at the likes of Germany, last 30, 40 years, the Deutsche Mark was one of the strongest currencies in the world, and they had one of the strongest economies in the world. The Swiss franc, one of the strongest currencies in the world, and they have one of the strongest economies in the world. As they move to, the Chinese in particular, move to progress, I suppose, and evolve as a society, they're very clear in terms of their goals that they don't want to be the sweatshop of the world, simply the manufacturing of trinkets for Western consumers and junk consumer goods for Western consumers who are buying junk they don't need with money they don't have on credit. So they want to move up the value chain. They want to, and they're already doing this to an extent. They want to be manufacturing the high value goods and services and technology. And they are going to gradually move to allow their currencies to strengthen over a period of time. It could be over a period of time, but it could happen more swiftly, because we've had these currency wars, ebbs and flows of currency floors for the last forever, but particularly in the last 10, 20 years. And then we have the trade wars now with China coming to the fore again. And there's a lot of the mood music in terms of the tensions between China and the US are as bad as they have been, arguably ever, or at least as bad as since the Cold War. At some stage, gold could become a geopolitical tool of state, a monetary tool of state, whereby the Chinese say, right, they declare, because they have been using already, they've been very public in their announcements when they've announced the revision to their total gold reserves. The belief is that they have something like the People's Bank of China has something like 1,950 metric tons of gold. Sorry, that's the declared amount of gold reserves that they have officially at the People's Bank of China. But there has been gold buying by two other massive Chinese entities, the Chinese Investment Corporation, the CIC, and these sovereign wealth funds that are believed to have been also acquiring gold, and they don't declare the increase or their gold purchases to the IMF. And Jim Rickards has said that there's a lot of gold going into China that's not been declared. Obviously, they claim to be the biggest producer of gold on the mining sector, which they may or may well not be, but I think they're a big producer of gold at the very least. Most of that gold, all of that gold, should I say, stays in China. And then there is a lot of anecdotal evidence that they are taking a lot of gold out of Africa in particular, and that's going into China. I think they probably have much higher gold reserves than they are letting on to the world, So rather than 2,000 metric tons, they may have 5 5,000 or 10,000 metric tons of gold. And at some stage, if the tensions with the US get very bad, or if the economies go into a bad enough depression and you have a massive financial crisis and you have problems in sovereign debt markets and with currencies, the Chinese may quickly move to partially back their currency with gold and to announce this is what our actual gold reserves are. They're also working on this digital gold fiat currency, so it's a Chinese fiat currency backed by gold. So it's very, very interesting indeed. And meanwhile, the US Federal Reserve claims, and the US claims to have 8,100 metric tons of gold. But obviously that has not been audited since Eisenhower's time back in the 1950s. So there's a lot of doubts about whether that gold is actually there in the New York Federal Reserve. And if it is there, how many times has it been resold into the marketplace or lent into the marketplace, potentially into the GLD gold ETF? So there's a lot of questions that have been asked there, and there has been very little answers forthcoming. And I think people are right to be dubious about the US gold holdings. So that's sort of a high-level view of it. There are huge advantages, as the US knows, and that's why the US maintains the pretense that they have the 8,100 metric tons of gold in not in Fort Knox, but in the New York Federal Reserve.
As we're speaking of governments saying they have X amount and possibly being untrue, it's making me think about the disparity between the gold and silver paper markets versus the physical markets. Could you tell us a little bit about how you see the gold and silver paper market manipulation versus what we're seeing in the physical side?
Yeah, and it's not so much paper anymore as electronic manipulation via the futures exchanges, which are electronic trading. And all it requires is a trader, a young trader, a so-called rogue trader. Lots of rogue traders on these precious metals desks of the various banks who've been prosecuted over the years. And indeed, the banks have been found guilty of manipulating gold prices and silver prices. And they've got the usual sort of fines and slaps on the wrist. These little fall guy traders and desks are found guilty. Meanwhile, their supervisors and the bosses of the banks go scot-free, and there's never any questions asked of them. So the bottom line is there's a huge amount of evidence that there has been manipulation, there's been prosecutions, the banks have been found guilty themselves. GATA, the Gold Antitrust Action Committee, Chris Powell and Bill Murphy, two stalwarts, international finance and of research, have done a huge amount of work, and they've amassed a huge amount of evidence showing that there has been manipulation both over the years and throughout the years, going back obviously to the London gold pool and more recently in recent years again. And they allege that basically the US authorities, the US Treasury, do not want the gold price surging. They want to control the gold price, because if the gold price does surge in value in dollar terms, then people will get concerned about the dollar. They'll get concerned about their dollar foreign exchange reserves. They'll get concerned about their dollar denominated US Treasuries. And they'll get concerned about their dollar assets in general, their stocks that are denominated in dollars. So there's a huge interest in the US authorities in obviously maintaining faith in the dollar and not allowing the gold price to get out of control as they may see it. So GATA have done the research, and there's actually declarations from the central banks themselves and from officialdom saying that they have manipulated the market. So I suggest anybody who has any doubts about it, conspiracy theories, there's conspiracies all the time, and banks are conspiring to make profits quite all the time, and governments are conspiring as well, and so is it a theory? It's no longer a theory. The evidence is there. So I suggest people go to gata.org. Is Chris Powell gold market manipulation? Why, how, and how long? And if you read that presentation from Chris, and he documents it with the various links into the various the circumstantial evidence, a huge amount of circumstantial evidence, and more recently actual evidence with the banks being prosecuted, So it's happened, but sometimes that puts people off investing in precious metals because they say, oh well, if it's manipulated, why would I buy it? But ultimately the free market decides the price of everything, and we're heading towards 8 billion people on this planet. And there's a huge amount of wealth that's been created in the world in recent years with the emerging middle classes in India and China, two nations that fundamentally believe in gold, and gold is in the DNA of these people, and they buy gold religiously as a savings vehicle because rightly they don't trust their banks and they don't trust their fiat currencies. They're a little bit wiser than us. And sometimes we look down at them and we see them as these poor peasants who believe in gold, is sometimes the articles I read in the Financial Times are very patronizing of these people. I think at times they'll be seen as wise and prudent. They buy gold religiously. They believe in it, and as do people in the Middle East as well. They buy I think it was Eid. EID was the Muslim religious festival the other day. It was very auspicious to buy gold at Eid. So the bottom line is it is manipulated, but that is going to be overcome by the forces of supply and demand of the people in this planet, because the gold market is a very small market in terms of the above ground refined supply of gold is 22 to 22 meters cubed. So it would fit in the centre court of Wimbledon. So they can play games in the futures market and they can manipulate it up and down and sideways for periods of time. But over the long term, the forces of supply and demand will dictate the price. And we're seeing that right now as we speak, because I think it was yesterday I looked at the silver price. We keep an eye on the discrepancy because we think it's an important indicator, discrepancy between the futures price and the spot price. And yesterday in silver, the futures price was $17.90 for the July contract and the spot price was $17.40. So there's a 50 cents disparity there, which is much, much higher than usual. And another indication of stress in the marketplace due to a lack of supply is just the huge premiums that people are paying, not just the retail level. So retail investors who are buying gold coins, gold bars, and particularly silver coins and silver bars are paying much higher premiums than they were a few months ago. But also the retailers. So when we go to buy from the government mints and the large refineries, we're paying higher wholesale premiums because there are these supply issues in the marketplace. That's what's interesting about that is it's the retail premiums, it's the wholesale premiums, but it's also the buyback premiums. So when our clients come to sell to us now, we're actually ourselves and other dealers and brokers around the world are incentivizing our clients to sell to us. So before, when we were buying a kilo bar back from a client, we might buy, depends how the volume obviously, but we might buy it 0.5% or 1% below spot gold for the kilo bars in a safe vault in Zurich or wherever it may be. But today, we're actually paying the clients 1.5% over spot, 2% over spot, because we're incentivizing the clients to sell to us. And we know we can get a higher premium on the sell side, so we're buying back a higher premium. So it's very interesting indeed, and that's a clear indication that the spot price and the electronic gold price is becoming, I suppose, slightly less relevant. So, and it means that if the gold price went, as some people call it, gold prices will fall sharply, and they may go to $1,000 and below $1,000 per ounce based on technical analysis or whatever, some deflationary crisis, which is highly unlikely for a variety of reasons. But even if that did happen for a short period of time, the electronic prices fell that level of period of time, you would find that the premiums on coins and bars would be astronomical, and people, because you would be in a massive crisis, and people therefore would be willing to pay even higher premiums than they're paying now. So they may pay 30, 40, 50% premiums over spot for your 1 ounce bars, so it might be $1,000 electronic price. But people don't care about electronic assets, or when it comes to gold, they want the physical hard asset. That's the whole point of owning gold. They don't care about the paper or the electronic. They want the physical coin or bar, the tangible asset, and therefore they're willing to pay a much higher premium. And potentially that's what we will see in a couple of months and years. So the spot price who knows, the spot price could go to zero if they really want to. We saw oil prices go to zero. So who knows if a bank really wants to create fear and loading in the gold market and blood in the street in the gold markets and create massive dysfunction and scare the pants out of the retail investors out there as they're scaring the pants off people about this so-called pandemic, then they could push prices much, much lower in the electronic market. But ultimately, the people who own physical gold, they will be able to command a premium, and they should just ignore it. And it would only be for a short period of time, before, as I said, the real world forces of supply and demand exert themselves.
Absolutely. Mark, as we know, you're the research director at GoldCore, and one of the recent articles on your guys' website, it's a pretty good source for news and research. It's talking about the safe haven role for some of the other precious metals like platinum, palladium, and silver. So could you give us a little bit of a rundown on where you see the role for platinum, palladium, and probably take silver as a little bit of a different offshoot? We've seen gold climb to within 9% of its all-time high, but we have yet to see silver jump as well to those kind of levels. So can you share with us a little bit about what role the other precious metals will play?
Yeah, well, we do look at them all, but I suppose we caution that platinum and palladium they're a lot more volatile, and they are not classic stores of value in the way that gold and silver are, because gold obviously has massive, significant monetary characteristics, and still does today, with central banks being the biggest net buyers of gold in the world today and the biggest holders of gold. And silver has been demonetized, but it still has a store of value characteristic amongst investors and amongst whether it be people in India and other nations in the world. Who could buy even silver jewelry. They view it almost as a store of value. Platinum and palladium are a little bit more classic commodities, so therefore they're driven by the cycle, the economic cycle, and in terms of industrial demand, and indeed in terms of jewelry demand, more so for platinum than palladium. We've long had the view that place for them in a diversified portfolio, if you're going to have a portfolio that has risk assets such as equities and bonds, and they are risk assets, it's important people realise that, particularly in the current climate. If you're going to have a balanced portfolio of equities and bonds and you have 40% in equities and 40% in bonds in a so-called balanced portfolio, which is absolutely crazy in this day and age. But anyway, and you have exposure to lots of stocks, and you've got exposures to S&P 500, and you've got exposure to Google and Facebook and Apple and Netflix, then why wouldn't you have a very small exposure to platinum and palladium? So our view has always been gold is your real safe haven, absolute hedge and safe haven asset, and allocations to gold can be 5% on the low side to 10-20% on the higher side, and even higher with the risk that we see today. Some clients go as high as 40 or 50%, which is akin to balanced portfolios have 40 or 50% in equities and bonds. So we think in the current climate that there's nothing particularly wrong with that, providing you're aware that there are risks of gold, and it can be somewhat volatile, like all assets today. Silver is more volatile, but we think will outreturn from gold from a return point of view. It is 1/100th of the price of gold. And that the long-term average throughout the last, only the last 100 years, 200 years, the long-term average is 15 to 1, 20 to 1. And then in more recent last 50 years, the long-term average is around 40 to 1. Between 30 and 50 to 1. So there will be, we believe, a reversion to mean, and silver will outperform gold, and it should do very well indeed. So you could have a portfolio allocation whereby you had 20-30% in gold, 5-10% in silver. I do think platinum and palladium, they are much more speculative and much more volatile, and I think that they are going to surge in value in the coming months and years, but they could collapse as quick as they surge. So you might have 1% in palladium. Palladium's had a good move up already as well. That's another thing that would make me concerned about palladium. Platinum, I think, will do very, very well indeed. It looks very, very undervalued, sub $1,000. And if you look at it compared to platinum's record high in 1980, if you adjust for inflation, it looks very, very, very undervalued. And also on the supply side, a lot of the platinum comes out of South Africa and Russia. And these are two nations that are, South Africa is very unstable, obviously, and there could be nationalization of mines in South Africa. It's quite likely, I think. And then Russia could actually flex their resource nationalism muscles, and they may, as they've done with natural gas before, they may stop the export of certain strategic metals for a period of time, in which case these metals will go through the roof. But that's a long way of saying, a good healthy allocation to gold makes sense. A healthy allocation to silver makes sense. A smaller amount to platinum, 2-3-4% maybe on the high side. And then, I think a very small amount in palladium, and it's already a big move up, so I think you'd be looking to sell the palladium as soon as it wouldn't be a long-term permanent portfolio position, platinum or palladium, whereas gold and silver would be, and you would simply reduce the allocations and take profits as the bull market progresses.
So as we were speaking about the gold to silver ratio, there's some people that believe that it's no longer valid to have that typical, let's say, historic ratio, and that it has no correlation anymore because, let's say, the industrial use, some people believe that it's not really a precious metal but an industrial metal now. How do you think about that?
Yeah, I think there's a degree of truth in that, but only a degree. And I'm just thinking, I bring up the gold-silver ratio, the long-term chart. It's important to realize that you have to look in terms of the supply-demand. And there is a wide variety of demand for silver, both on the investment side and on, as you said, the industrial side. So as I was saying before, while silver isn't a classic safe haven, it's not a monetary asset, it has been demonetized. There are still a lot of people around the world, both the middle classes of India, China, and much of Asia, who view silver as it's poor man's gold, and they will buy it particularly when they see it as being undervalued, and they buy it as a store of value. value. They buy it as a savings mechanism. They do see it as a form of money. The silver ETF, the growth in the silver ETFs in recent months and years has been very strong indeed and consistent every year. The holdings have been increasing. So there is some big investment money in the world as well that sees silver as, at the very least, very undervalued, and they see it as an attractive asset. They may not see it as money per se, but a lot of them see it as an attractive asset that will do very well in terms of performance. So the ratio, why the ratio is 15, this is important to understand. Why the ratio is, people talk about long-term, historical ratio, 2,000 years, 3,000 years is 15 to 1. That's because in the Earth's crust, the ratio is 15 to 1. All the gold and silver that's mined over the the millennia, the ratio is 15 to 1, and yet a huge amount of silver has actually been used up in industrial applications over the years and used up in mirrors and photography in the last 150 years. So the above ground ratio of gold to silver is very low indeed. I don't know what the up-to-date figures on it are. But bottom line is that 15 to 1 is the ratio in the last 100, 200 years. But if you looked at just, as I said, the last 100 years, the ratio, I think it averages around 30 or 40 to 1. If that was the case, then why in 1980 did silver go to, so it was $8.50 on gold and it was $50 on silver. So the ratio was 17 to 1 at the record highs in January 1980. So if that was the case, people were saying the same thing in the 1960s and 1970s. They were saying, oh, well, silver is no longer money, gold is the money. And yet that happened. And then again, it happened in 2011, 2012, more recently. So back then, obviously, gold got up to $1,900 per ounce, and silver got up to nearly $50 per ounce. So you divide 2050 into 2000, and you get 20 to 1. So that the ratios at 20 to 1 only 10 years ago. So I think given the supply-demand equation and also the fact that the silver supply is inelastic, so when you get a massive financial crisis, there tends to be more demand for silver on the investment side and on the store of value side. But there tends to be less supply of silver because when there's an economic crisis, there is less mining of base metals. And most silver that's mined in the world today is a byproduct of zinc and nickel and base metal mining, So if we have a depression, which unfortunately I think we are going to have, then you're going to see the less production of base metals because there's less demand for cars and for houses and for infrastructure in general. That's why the ratio is likely to revert to the mean. And maybe they're right. Maybe it won't go to 50 to 1 because silver is less money than it was before, should we say. But I do think the 20 to 1, 30 to 1 ratio is very likely indeed, given the very small amount of above ground refined silver in the world. And all it takes is a small amount of capital. I think there's something like $300 trillion worth of capital in the world, roughly broken down into 100 trillion in stocks, 100 trillion in bonds, and 100 trillion in cash. So all it takes is a tiny trickle of that, 0.5%, 1% of that to flow into silver, and the silver price goes up, 5 times, 10 times. And that was what was seen in the 2000s, from 2000 when silver was below $5 in the year 2000, and then it rose 10 times to nearly $50 in 2011. So I think the same thing is going to happen again for those reasons.
Very interesting, Mark. One of your favorite sayings that I've been thinking about lately is price is what you pay and value is what you get. Can you explain a little bit about that, about how you see that when we're buying physical?
It's Warren Buffett's a great expression, and that's absolutely true. But Warren Buffett, unfortunately, he has his own blinkers when it comes to gold, but he doesn't have any blinkers at all. He realizes gold is the anti-dollar, and he's talking his book in a huge way. And if Warren Buffett said anything positive about gold, then the price of gold would double or treble, and the US Treasury and Federal Reserve would be coming after Warren Buffett. Plus his shares in Berkshire Hathaway, which are denominated in US dollars, would be massively devalued. So he's never going to say anything positive about gold, But anyway, he is a very shrewd investor, and you have to acknowledge that. And I have a lot of respect for him, except for what he says about gold. He says price is what you pay, value is what you get, and that's why you have to look for value in shares. You look at the intrinsic value, you look at the cash flows, you look at the income that the company will throw off. So what's the value of gold? Well, the value of gold is peace of mind. Our clients, retail investors, high net worth investors, family offices, companies that own gold, they realize there's huge risks in the world today in terms of currency devaluations, bank failures. I don't know if people have looked at HSBC's share price. All the focus of the world is on this so-called pandemic. Meanwhile, if you look at the HSBC share price, it's trading near all-time lows. It looks like it's going to break lower, like multi-year, 20-year lows. Deutsche Bank has huge issues. So there's a financial crisis, and the financial crisis was brewing before this so-called pandemic kicked off, and the crazy lockdowns. People who own gold realize that there's huge risk in the world, and they realize that by having gold in the safest vaults in the world and the safest jurisdictions in the world, they realize that they have a degree of protection. There's no absolute protection, but there is some protection. They have some protection, so that they sleep easier at night, knowing that the assets that they own, they have a hedge against currency devaluations and bank failures, the risk posed to deposits. So it's peace of mind. It's a hedge that's seen in all the research, the academic research, the independent asset allocation research. Gold tends to go up when stocks and bonds fall, and that was seen obviously during the last crisis. Obviously, also when property markets fall, gold does tend to go up, because when property markets fall, it tends to mean that there's an economic recession or depression. And it's also very importantly, and this has not been acknowledged in the mainstream media as of yet, they pigeonhole it as a sort of a quasi safe haven, and sometimes they even try and question that, even though all the research and the data is there. They don't acknowledge that it's a source of returns that has actually outperformed stocks over the long term. And if you look at the long-term returns now, and the World Gold Council do some excellent research shows that gold returns are roughly in dollar terms, and the dollar is obviously the strongest currency in the world over the last recent months and the last 10, 20 years, So gold is returning 10% per annum plus in dollar terms, and it's returning much more in other fiat currencies. We frequently share the excellent gold performance in fiat currencies chart from goldprice.org, which looks over the last 15 years, all the major currencies, from going back 2005 to 2020, the percentage of performance every single currency, and then the average value of the 15 years. And again, it's 10% per annum. In dollar terms, and more, as I said, in other fiat currencies. And if you go back to 1971, when the US went off the gold standard, you're seeing similar returns of 10 to 12%, So it's crazy that the mainstream media and many financial advisors and people who are either ignorant about gold or have their inbuilt biases about gold don't actually look at the data, look at the research, and acknowledge the source of returns, particularly in the environment we have today, when you have negative interest rates on bonds and there's no returns on bonds, and there's the dividends being paid out by companies are going to come under pressure as well. So gold has been a source of returns in the last 15, 20 years, and it will be an important source of returns, not just a hedge, not just a safe haven, but also an important source of returns. I think that's quite a fundamental point, that it will gradually, hopefully, the media and the so-called financial experts will acknowledge that in the coming months and years, because it's going to be very important for investors, and also pensions, because pensions, a lot of them are obviously in the balanced portfolios of stocks and bonds. They need a source of returns along with a hedge, and gold is absolutely perfect in that regard, and it really is a no-brainer. And you can't claim to have a fiduciary duty to your clients and not actually look at gold. I think it's irresponsible in the extreme in the current climate for financial advisors and brokers not to look at gold if they genuinely are about protecting and growing the wealth of their clients.
Interesting, Mark. Do you have any concluding thoughts as we wrap up here?
No, it's a beautiful day. Go out. Hopefully it's a beautiful day wherever the people are when they get a chance to listen to this podcast. Go out into the fresh air and get plenty of sun and vitamin D and get that into their immune systems, and they'll be fine. And we'll all be over this little scare story that's been created for us in recent weeks and months in this pandemic. I hasten that. That's not a GoldCore view. We, like everybody, are grappling with this issue, and there's different schools of thought within the company. But that's my view for what it's worth, and I think people need to be more concerned about the economic ramifications of these lockdowns and the financial implications in terms of the outlook for our financial markets and for our investments. I would say don't worry about the pandemic. Be happy, enjoy your lives, get on with it again. Take the certain precautions that have to be taken, but with our elderly, obviously, we have to be super cautious in that regard, and people who are immunocompromised. But the majority of healthy people and well-able people need to go out there and get on with their lives and just shut down the fear, because there's a lot of fear out there, which is totally counterproductive, and it leads to quite irrational behavior and irrational outcomes.
Perfect. And of course, you're Mark T. O'Byrne, Byrne, and at GoldCore on Twitter. We remind everybody to follow at Palisade Radio as well. Mark, thanks very much for your time today.
Yeah, and just at GoldCore on Twitter as well. And we're on Facebook and YouTube and all the various channels. And people can subscribe to the market update as well on goldcore.com, the daily market update we do.
We'll have all those in the show notes. Thanks, Mark.
Great stuff, Tom. Thanks again for having me on.
think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?